Welcome back to Alpha Recap. Today we are breaking down the tape from January 28th, the session that finished with a clear tech tilt. As always, if you have questions, you can reach us at stockalpha.ai.
Good to be here. The market closed up with the S&P 500 ETF finishing up about 0.4%, while the tech-heavy Nasdaq 100 ETF outperformed, gaining just under 1%. Even small caps chipped in, with the Russell 2000 ETF up roughly 0.3%.
So that was a selective risk-on day, not a blanket rally. Big cap growth led, but there was rotation underneath. Communication services, some industrials and renewables-linked utilities all saw flows. Meanwhile, pockets of real estate and parts of the financials looked heavier.
Exactly. The headlines were really stock-specific. Earnings previews, company updates, and sector news drove a lot of the moves. Think of it like a room where a few popular people were getting all the attention and everyone else was having a quieter evening.
I like that analogy. Let's walk through the big drivers. First, corporate news flow. Boeing reported before the bell. Microsoft stayed in the conversation about its long-term growth model. Tesla had what some called an ugly print, but still climbed. And UPS delivered a solid fourth quarter. Those items created idiosyncratic swings more than a single market narrative.
Right, Tesla is a great example. Earnings weren't pretty on the headline numbers for some, but delivery volumes and signs that margins were stabilizing let the stock climb. High beta names can flip sentiment fast based on delivery and guideposts rather than straight EPS comparisons.
And Microsoft participated in the rally as traders priced in more enterprise AI adoption. Analysts were debating how the company's AI investments would translate into durable revenue growth, so there was a lot of speculative appetite around those cloud and AI names.
That fed into the tech leadership. Investors favored AI-adjacent names and cloud leaders, companies where spending is expected to keep flowing from enterprises. Communication stocks got a boost too, partly from media and ad recovery chatter.
On the sector rotation front, industrials and materials were mixed. Some industrials rallied after bullish analyst notes about backlogs and automation spending, and materials and mining names moved higher on commodity-linked flows, so it wasn't only tech getting bought.
Utilities and renewables were interesting. Renewables-linked utilities picked up on project deal news and policy signals. Those groups looked like beneficiaries of the transition narrative, at least for the session.
Conversely, real estate struggled as investors kept focusing on how higher for longer rates and tighter credit conditions affect leasing and cap rates. Financials were mixed as well. Banks faced some pressure from credit concerns and funding costs, though fee-based businesses showed pockets of strength.
Don't forget energy. A tighter supply backdrop and strong oil flows helped energy names, and even electric vehicle charging stocks got a lift from infrastructure chatter and adoption narratives.
Let's unpack the macro backdrop a bit. Inflation readings have been trending towards stabilization and growth, hasn't cratered, so the market was behaving as if the Federal Reserve was on hold for now. The assumption was that any move to ease would be gradual, unless inflation or jobs data surprised sharply.
Put simply, the market was acting like the Fed had paused. That favors long-duration growth names, companies whose profits are expected further out in time and whose valuations are more sensitive to interest rates. That was part of why the Nasdaq outperformed.
And we should explain one technical term for listeners: breadth. When we talk about breadth contracting, we mean fewer stocks doing most of the work. Today felt healthier because volume patterns suggested institutional participation across specific themes, not just a handful of names carrying everything.
But the warning was there. If gains concentrated even more in the top handful of names, you'd raise the risk of a short-term mean reversion. In plain English, if only 5 companies kept the index up, you'd worry that could reverse quickly.
Okay, quick hits on individual movers. Microsoft participated in the rally as traders looked through AI and cloud momentum. Tesla climbed despite a mixed report. Boeing's before the bell release created volatility in aerospace. UPS had a nice pop after solid fourth quarter numbers.
Disney drew attention after a big bank kept an overweight call thanks to streaming strategy and park recovery talk. And a bunch of smaller names, Pinterest, Fat Brands, Twin Hospitality Group, moved on corporate filings. Those 8K notices tend to create single stock drama.
And crypto-linked plays did well because Bitcoin rallied and regulatory context kept some high-quality crypto infrastructure stocks in favor. Payments names and infrastructure businesses tied to digital assets benefited.
Now, what should listeners watch next? Number 1 was continued earnings and guidance updates. That was going to keep the tape stock specific and volatile. Big tech and industrial reporters were the ones to watch.
Number 2 was economic data, upcoming inflation metrics like CPI or PCE and labor figures. Any deviation there could shift Fed expectations and rotate flows between growth and value quickly.
Number 3 was Fed speak and minutes. The market remained sensitive to wording from regional Fed presidents or the minutes that could hint at a tilt toward tightening or easing. A hawkish line would have flipped sentiment fast.
Number 4 was sector flow monitoring. If communications and AI-related strength broadened to mid-cap and small-cap tech, that would be a good sign for healthier risk-on breadth. If flows rotated back into financials and energy, that would signal a re-rate towards cyclicals.
And number 5 was crypto and regulatory headlines. Continued strength in Bitcoin plus regulatory clarity could spill into equities, especially payments and infrastructure plays tied to digital assets. Traders needed to mind options volatility around big earnings and data.
Let's give listeners 3 clear takeaways. 1. It was a tech-led but selective rally. Big cap growth drove the day, but there were pockets of cyclicals and renewables participation. 2. The macro backdrop still favoured a wait-and-see Fed, which supported long-duration growth. That was a key reason the Nasdaq outperformed. 3. Breadth mattered. The market wasn't melted up, so keep an eye on whether strength broadens beyond the mega caps.
I'll add a tactical note. If you're trading short-term, watch implied volatility around major earnings and data releases. Options flows and delta hedging can amplify intraday moves. For longer-term investors, prioritize earnings quality and how each company is positioned for a Fed that's likely to be data-dependent.
Before we close, any final thoughts on positioning or risk? I'd say stay selective. The bias was modestly bullish, but dispersion across sectors meant there were both opportunities and traps. Be ready for quick rotations if inflation or Fed commentary surprise to the upside.
Agreed. Keep your watch list tight and your risk controls tighter. Earnings season was the headline generator, and with macro prints coming, traders needed to respect the potential for rapid shifts.
All right, that wraps up our recap of the market close on January 28th. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back with more recaps and context after the next session. Head to stockalpha.ai to ask your questions and stay in the loop.